Hi, I'm Patrick Ritchie, and in this webinar, we're going to talk about financing a home with a reverse mortgage. So who can do a reverse mortgage? Well, borrowers 62 years and older are eligible for a reverse mortgage, and they can use it for purchasing a home. Typically, we think about somebody tapping their equity to receive cash each month, which they can still do when they use it to purchase a home, but we don't generally think of it as much in terms of just outright purchasing a home. So why? Why would somebody use a reverse mortgage to purchase a home? Well, the big reason is the fact that there's a lot of different features of a reverse mortgage compared to the traditional forward mortgage, which is what we typically would talk about in the mortgage industry and what we typically would see in terms of somebody financing a home. So there are major differences between a reverse and then the traditional forward mortgage. So probably the biggest benefit is the fact that there's not going to be a monthly mortgage payment. And for somebody who's retired, that can be a game changer because they're not qualifying for a certain monthly payment. And with the fact that they don't have a monthly obligation, it could make it more affordable for them to get into the home that they want. It could also allow them to defer the receipt of Social Security benefits, which could increase their future income based on their circumstances. So if they don't have a housing payment to make, that could allow them to hold off on getting those Social Security benefits, and in the long run, that could actually be a huge advantage for them. There's a lower upfront investment when you compare it to paying all cash. If somebody is wanting to buy a house for $300,000 and they have $300,000 in cash, well, is it better to have that money just sitting there in a house with only the return of the home appreciating, or would it be better to put in maybe 50%, put in $150,000, and then from that standpoint not have a mortgage payment, hold on to their other $150,000 and be able to either use that for expenses or to invest whatever is going to be ideal for their situation. But it does free up money, and that's really the big thing. Is it frees up money, and everybody's situation is going to be a little bit different, but at least the option is there to not have to pay all cash and to also not have to try to qualify for a monthly mortgage payment. It's easier to qualify for a reverse mortgage compared to a traditional mortgage. There are some changes going into effect in January of 2015 where some things will be looked at that haven't been looked at in the past. But generally speaking, you don't have the credit requirements, you don't have the income requirements, you don't have a lot of the qualifying process that you do with a traditional forward mortgage. So the reverse mortgage really is about age, being 62 years or older, and it's about equity position. Those are the two main things. So what we typically would think about in qualifying for your traditional mortgage, it's just a much different type of program. It's really about the age, and both borrowers have to be at least 62 years of age in order to do a reverse mortgage. And it must be their primary residence. So it has to be their primary residence, and they must occupy the property within 60 days of closing. So they have to operate within those parameters. So how much money does a borrower actually need in the transaction to do a purchase? Well, there's guides on that, and it can vary, but a good rule of thumb is at least 48% is about right. That's going to vary based on age. So there are some variables there, but 48% is a good rule of thumb to at least get an idea of how much money somebody would need in order to utilize a reverse mortgage as a purchase. So this is a question that comes up: will the bank own my house? And you hear that a lot. You hear a lot of talk when it comes to reverse mortgages of, well, you're giving up your house, you're doing this, you're doing that. Well, it's just like a traditional mortgage in the fact that the borrower still remains on title. They are still the owners. Obviously, there's a lien position for that loan against the property. And so if they were to sell the house, that lien would have to be taken care of. It's obviously different from the traditional mortgage in terms of no payment is being made. So the amount owed is accumulating each month because of the interest that's going to be paid later on, because it's being deferred on a month-to-month basis and would then be paid at the time of payoff. Unless somebody elected to pay towards interest during the loan period, they could do that. But the borrower does remain on title. They own the property. It's just that the loan itself will be a lien against the property. So you do have that encumbrance just like you would on a traditional mortgage. So will the bank take the house when the borrower passes away? A lot of times heirs can be worried about, well, this house is gone. Basically by getting a reverse mortgage, we're surrendering this house and we're not going to get an opportunity to keep the house, especially if it's a house that that maybe the family would like to keep. Maybe it's a house that's been in the family for a while or something of that nature. But the reality is that there's 4 reasons why the loan would be due. Number 1 would be if all the borrowers, assuming a husband and a wife, moved out for, if they move out permanently or if they move out for at least 12 months. As soon as they vacate the property and it's no longer their primary residence, the loan is now due. Or if the home is sold, just a traditional sale, then the loan would have to be paid off from those proceeds as far as what is actually owed at that time. If taxes and insurance are not being paid, that's another reason where the loan would become due. So it's really important to make sure that those taxes and insurance are being paid. And in some cases, it might be possible to set it up so that the reverse mortgage itself is paying the taxes and insurance. That may be a possibility to make sure that is taken care of on the basis of when it's actually due. And then finally, the last surviving borrower passes. Let's say that we have a husband and a wife, and let's say that one of those spouses passes away, but the other one lives for another 10 years. Well, the loan is not due until both borrowers have actually passed away. So it's not like one spouse is going to pass away and then the other one has to get out of the house. They actually would be able to stay, assuming that they are actually on that loan. If they're not on the loan, different story, but assuming that they're both on that loan, the loan would not be due until the second borrower has passed away. And at that point, the home could be put on the market by the surviving heirs. And from that point, it's just a matter of selling it at fair market value. And then whatever the loan amount due is, it just has to be paid. Same as with a traditional mortgage. So what if the loan amount due exceeds the current fair market value of the house? The lender in that situation would actually take the loss. It's their gamble. It's their calculation. In looking at the equity and looking at the age, those are the 2 main variables regarding how much money somebody might get on a monthly basis from a reverse mortgage. But if there is more owed at the end of the term than what fair market would actually get, the heirs don't owe more money. The estate does not owe more money. It's based on whatever the fair market value is. Now, the most important thing is if any of those 4 triggers for the loan to become due, if they happen, it's really important for communication to occur. Generally you've got 6 months to get the home sold. And as long as people are communicating, there probably wouldn't be a problem. The issue is when there is no communication. So you hear these horror stories of, they took my parents' home. Well, if the parents vacate the home, it does trigger the loan to be due. So it's really important to communicate. It's really important that everybody understand what it means when the loan is due. Those 4 trigger points. As long as everybody's aware, there shouldn't be a problem. So that's a reverse mortgage. How does somebody use a reverse mortgage to purchase? Obviously, there's some good advantages there. It's another option to try to grow your business and sell more homes. So join us next time. If you want to learn more about credit, go to creditliteracyproject.com, where you can read blogs and see more videos and look at some of the books and information that we have available. So I'll see you next time.